We're about 2 hours or so away from the next update from the FOMC, and to help us understand what we might be able to look out for today is event trader and chart trader, so I'm going to welcome both of these gentlemen in.
What's up, Jim?
Howdy, Jim.
Howdy to you both. So I want to give everyone a heads up here that if you would like to follow along or at least get an idea of some of the things that we're going to talk about here, Gavin, event trader, did post a Fed preview yesterday afternoon, so I can direct you to the timestamp there. It was April 30th at 13:07 on the in-play page, so I believe they're going to be following along with that, so I will keep it up here, and then I'll adjust the charts as we talk about the different markets and whatnot. So, without further ado, gentlemen, I'll give you the floor.
All right, Brett, I'll just do a quick recap of what we're looking at then, and then we'll figure out where we want to go from there. But obviously, we got the Fed meeting this afternoon. Fed, as of late, has had a bit of a 180 turn from its December meeting. Recall at that point they were still moving along with their gradual rate hike language, but over the last couple of months we've seen them pivot to a more neutral stance. In fact, perhaps even pivoting a little too much, as we're now pricing in about a 50% chance of a Fed rate cut in the September meeting. Personally, I think that they might be getting a little bit ahead of themselves, but one of the things that we're going to be looking for intently on this is, number one, I do think that the Fed's trying to be as ambiguous with this Fed meeting as possible. I don't know if they're going to be able to achieve that, given the amount of uncertainty on direction right now that the market has with the Fed. At least in my opinion, perhaps the bond market is a little bit more intent on seeing the Fed perhaps even lowering rates, given some of the yields that we've seen out there. But the thing for me, Brett, that they need to really try to help the market understand is where their outlook is on the economy and on inflation. And with that in mind, I really think the context in their statement around those two areas are going to be two of the more important things that the market's going to be looking for, and certainly something that I think is going to be addressed prominently in Fed Chair Jerome Powell's press conference, which goes off at 2:30 p.m., 30 minutes after the statement. So we're basically going to get the statement and probably some whippy action in reaction to it until we can get Powell in to try to help settle things. But for me, Brett, looking at the commentary around the economy and the commentary around inflation is going to be the key items here.
Yeah, absolutely. I mean, I think that you've always got to look at these things like they're sort of a multi-level kind of process, and I think that what I am listening for is the degree to which they throw out some justifying device. You know, there's a lot of pressure for them to ease policy now, probably in conversations that they're having with other central banks around the room that we don't hear anything about, and certainly with any conversations that are happening between them in the White House. There's a lot of pressure to sort of proactively loosen policy. The Fed funds futures market is kind of getting out in front. We've talked about this quite a bit over the last week or so.
To say that we know where the White House's stance is on this.
I think it's pretty safe
the
to say.
central bank meeting might be closed doors. The other one's on Twitter. So.
Well, and I would imagine there's a lot of people holding dollar-denominated debt around the world that are with the White House on that one, and I think that probably there's who knows what the genuine reason would be for what I call acquiescing to where the Fed fund futures are leaning. What I'm listening for is throwing out some justifying device. And I think that the idea that would signal to the market that they may be willing to kind of move in that direction and do a very proactive policy move, despite what looks like, face value, strong economic data, would be to talk about flexibility in terms of inflation targeting above the 2% level as a kind of counterbalance to all the time that we spent below the target level, which has been thrown out there a lot of times. And I think that's a device, I think, for them to signal that they're going to be moving further in that direction. And so I guess that's what I'm really listening for today, to see if they start to talk about, the importance of possibly being flexible above 2%.
I'm trying to think, what was the term for hitting 2%, not so much as a target, but as a constant
I think that it was price.
Like price. I'm trying to remember. It was a pretty big term thrown around in 2017.
Yeah, I remember that. Like. Yeah, right. It might have been price targeting.
Price targeting. I think that's what it was.
Which basically means, if you go back, so for everybody listening, the idea here, the conceptual shift is, if you think about the way that inflation is normally measured, inflation targeting is a rate of change year over year. But if you imagine, let's say some widget cost $2 several years ago, and the target rate of inflation at 2% would mean that it would be up to, let's say, $2.30 today if they had been at target the whole time. But if they're under target, it's still going to be, it's at $2.20, and moving up to 2% inflation, it will still be well below where it should be if they'd been at target the whole time and the price had been increasing. So if they target, let's try to get that widget to $2.40 or whatever, then they're going to have to let inflation run at 3% for a while to get it back up to where it would be kind of on schedule over time as a rate of change to make up for the period when inflation was growing too slowly.
Right. The idea being that they don't want to just hit that 2% target. They want to average that 2% target.
Yeah, so they have to hit much above that for a little while.
Exactly, that they'd be content with an easing, certainly. That would, price targeting of any sort of mention, I think, that would be the code word there for the Fed looking for a little bit looser inflation target, and that's basically what you'd be looking for, Brett.
Yeah, they may not use that word. That might have become a word they try to stay away from, but doing the same thing anyways would just mean, flexibility above the 2% target. Something like that. Or the word overshooting might be thrown around. If they're looking for a device to justify, starting to loosen policy now despite, 3.2% GDP or whatever in Q1.
With that in mind, one of the aspects from the last March 20th meeting that I found interesting was their commentary on economic activity. This is directly from the Fed March 20 directive. Economic activity has slowed from its solid rate in the fourth quarter. Recent indicators point to slower growth of household spending and business fixed investment in the first quarter. Obviously, we did not see that. Do you see them tweaking the economic commentary at all, or would leaving the economic commentary similar also be another tool that they could be using in order to kind of highlight to the market that, hey, we are okay with a further easing policy?
Okay, so here's how I see that. Just as talking about inflation, letting it overshoot the 2% level might be a communication device to rationalize or justify a looser than typical policy, the way to justify the exact opposite would be to talk about the economy as being in a strengthening phase or stronger than expected or whatever. So if they upgrade their language about the economy, whether or not that's the reason for what they're doing, they might be trying to justify to, let's say, the White House why they're not going to cut rates in September. So either way, I think that it's a platform of messaging to one side or the other to justify where they're trying to coax the Fed Fund futures if the Fed Fund futures are right now out of whack. And I think that, I've talked with you about this quite a bit, I think that there is a conversation between the Fed and the Fed Funds futures market and the currency markets through the medium of the press conference communications and Fed speeches from everybody. They're constantly trying to, they've got an idea of what they want to do, and they want to make sure that it's not a huge surprise to everybody, so they need to find communication devices to coax those reads in currency markets and in Fed Fund futures into line with expecting what it is that they want to do. So if they're looking at the September Fed Fund futures contract right now and saying, what are these guys doing? That we're not going to be cutting in September, they're going to need to throw out some positive communication on the economy to get that to happen. And then they'll reinforce it over the next few weeks. As we talked about yesterday, there's going to be a bunch of Fed speak coming out. So it depends on what they want to do, and that's why I would look at these sorts of things as, a Sherlock Holmes process of just trying to pick up clues about where they're trying to push expectations, and they're going to be using different devices to try and do that. And I think focusing on inflation we should be flexible, about where our target is right now, because we've got some ground to make up. That kind of language reinforces the idea we may be seeing a cut coming in September. And if instead of talking about that, they start talking about maybe upgrading some of their commentary about the strength of the economy, that's probably signaling something in the opposite direction. And so I suppose those would be the two sort of devices that we might see in play.
Yeah, I think one other, and just for people wondering what Brett's talking about for Fed speak, as a reminder, on Friday we're going to have the Vice Chair, Richard Clarida, speaking. We also have Chicago Fed President Evans. We have New York Fed President John Williams and Governor Michelle Bowman speaking, and St. Louis Fed Randy Bullard, who's a voter, or James Bullard, who's a voter as well. So a lot of people are going to be speaking at an event on Friday afternoon, and you can be sure that the timing of that event was set to correspond to make sure that the message that we get from the directive and Fed Chair Powell comes out properly.
It's clear. Yes,
and it's clear correctly. Correct, I should say. So one other thing that I think for the economy, Brett, is they could always mention international on this side too, to kind of even off an uptick in or more hawkish stance in the economic language. Would you expect to see that? It's rare that they do mention it, but I guess that is one option that they have in order to kind of tone down market concern about an overly aggressive Fed on the hawkish side.
Right. I mean, and that device would fall in that, inflation overshoot camp in terms of justification and rationalization. But yeah, and I think that we did just see a surprising positive inflation shift in Germany. I don't know if that really enters into their equation at this time frame, because it could very easily be a one-off kind of gyration in the market. But yeah, I mean, I think that's I really don't take anything at face value, and I just kind of look at, what are they justifying? And I think that obviously talking about international risks is a way to justify. That's been used quite a bit to justify not hiking as fast when they slowed down the pace. And I think that kind of works in that direction. Certainly, if they announce it in the opposite direction, if they say that international risks have eased, it's very clear to see, the signal they're trying to send there.
Okay, so we talked a little bit about the economic activity. One other item that I think could potentially be tweaked is the business fixed investment commentary, because as we said, business fixed investment, there was slower growth there in the first quarter, they said, and in the Q1, business fixed investment grew only 2.7% in that GDP number that we saw. So that's another item that I'd have on the economic side of things. But for inflation commentary, Brett, last time we heard them talking, they said on a 12-month basis, overall inflation has declined, largely as a result of lower energy prices. They also noted inflation for items other than food and energy remains near 2%. On balance, market-based measures of inflation compensation have remained low in recent months, and survey-based measures of longer-term inflation expectations are little changed. When you're talking about that tool that they're looking to signal, in that statement, where do you think that they could potentially tweak this, that the market will be thumbing through and looking for an immediate reaction to the commentary?
Well, I mean, I would assume that their perception of that situation is that inflation is a little weaker than they thought last meeting. Probably right?
Right. Perhaps maybe move away just the lower energy prices is the only reason, because for me that always strikes as a little bit more transitory. Sure.
And energy prices have risen, and yet inflation is weaker. So right. It suggests core inflation pressure, a drop. So, I mean, I suppose, I think it's just in how they choose to communicate it. I think that if their bias is that they want to be on hold and they really don't want the market to run away with expectations of a cut, because if they don't want a cut, they certainly don't want the market to start pricing a cut, because there's your route to roiling the markets when you don't do what the market's expecting. If the market's expecting policy easing and the Fed is in a position where they really don't want to do that, they're going to need to find a way to get the market expectation in line with the path that they want. And I think that they can choose to highlight inflationary pressure, low inflation, as a device to go in that opposite direction. But if they just choose not to really discuss slightly weaker inflation readings very much, it's particularly in the press conference, I'm sure that will be in Q&A. And just how I'm sure that he's got a plan coming in about, if he doesn't want to cut in September, and he doesn't want the market to expect a cut in September, he's probably not going to dwell a whole lot on the downtick that we've seen. He's probably going to frame it as transitory, or as short-term and not really an indication of a longer-term read or something like that. Or, if it's the other direction, if he's trying to justify that they are going to be moving toward a very proactive loosening of policy, which is the big thing in play today, I think, between the lines. And you're not going to get the definite answer, but you're going to get hints. And the way to get a hint of, do they want to eventually maybe start to do a proactive loosening of policy over the next 6 months at some point, if that's the direction they want to be heading in, then I think that he does kind of really point out, the risks that are posed by unexpectedly weak readings on inflation.
Okay. All right. So, Jim, with listening to this, is there anything that's sticking out to you, or that you would have questions about, that you're curious on for market reaction?
Well, just overall market reaction, I'm always curious about, and assuming you get exactly what you laid out. So that's like the most likely scenario.
So the base case for this, Brett, I'll lay out the base case, Jim. You tell me if you think you've heard otherwise. A slightly more hawkish tweak to the economic language, but perhaps with the caveat thrown in, and then definitely a downtick or a dovish move in the inflation commentary. I think that's the base case. Would you agree with that, Brett?
I don't know, and I'm dying to find out. I don't know. So I'm not trying to come in with a guess about that. I will say this. If they clearly signal, hint, whatever, in the direction of keeping that, if the Fed funds futures, if we hear something that keeps the Fed funds futures kind of, sort of leaning toward a possible hike in September, or maybe even pushing into a hike in September based on what he says, however it adds up, however the on-balance message is, then I think that the idea that you've got strong economic data and a proactive loosening of policy certainly bodes for the melt-up idea in the market.
And I would concur.
I don't think that's fully priced in.
I would agree with that, and that would probably be what I would be looking for. I don't expect too many hiccups or too many surprises, and you guys laid this one out already. But what would be the big? What would be that run up and then the reversal? Because many times we see that in the Fed reaction, where things seem all right, and then as soon as they stop talking, all of a sudden we get a big reversal in the market. And sometimes we don't know what that may be caused by until maybe a couple days later. But if that was to occur and we get a spike higher, what do you think would be the thing that would trigger that?
Let me jump on this one first, because I have a scenario in my mind where I've been kind of thinking about this. And so the idea that you get this initial knee-jerk to the upside that's a great fade, I think that would be if they don't do both of the steps Gavin just outlined. If they do maybe weaker commentary on the economy. Look at the PMI we had today. Who knows what they're seeing coming at them. If they see weaker economic, and that justifies we need to let inflation run higher, Fed funds futures pricing more of a cut in September, market takes off to the upside, but on given a couple hours of thinking it through, we start to trickle back down because, oh no, wait, there's a cycle risk. That we're deteriorating economically under the surface, according to what the Fed sees. I think that would be that kind of delayed reaction reversal and turn back to the downside. You don't really want necessarily the bump on the easy policy if it really is because the easy policy is definitely necessary.
So the idea being that the Fed could get too dovish.
Well, no. The idea that it's...
And then you're wondering what's under the hood that has them so concerned?
Oh, okay. So, yeah, you mean dovish. Well, in the economic language. So, I've used the term proactive loosening. If the market sees the loosening and then starts to realize, oh, it's not proactive. You understand what I'm saying?
Right. They're reacting
going wrong
because the economy's too already sliding low.
We need a hike. We need a cut. Yeah, that according to what the Fed is starting to see, that we need a cut. Like if you look under the surface of the GDP data, you could kind of try to make a case, that there was a sort of under the surface weak read on the economy in Q1, even though it looks on the surface to be strong. So, you can reaffirm that the PMI deteriorated a bit. Maybe we see something else. Maybe the Fed's got a sense that things are deteriorating more than they would seem under the surface. If the market gets a sense that risk is out there and that this would be a reactive cut coming up rather than a proactive cut coming up, I would say that would be, and I'm not saying that's going to happen. That's a scenario that could lead to the type of reaction sequence that Jim was discussing.
Yeah, for me, I definitely see people trying to lean on the market on whatever commentary. I'm having a tough time envisioning a move that doesn't involve a buy on the dip, to be honest, just because, we've gotten a fair amount of earnings season in right now, and I think it's been good enough for people to kind of be able to buy in a little bit more comfortably without a big concern. We haven't seen a ton of red flags. Most red flags that we have seen around has been around China, I would say, but yet we continue to see mixed economic data from there, and we know that the stimulus remains in play, and we know that we're not far away potentially from some sort of a trade deal. So it's really tough to see it, but like Brett said, if they come out uber dovish or something, I'm not saying that Brett said uber dovish, but something that would cause that melt up to just jolt right into place, you could get the fade, but I still think that fade would get bought even at this point too, just for the idea of a search for yield.
Let me interject something, and then you continue, because I just want to frame for everybody that our Sentiment and Flow show also suggests that what Gavin is saying is true, simply because we keep on covering this data that shows that there's a whole lot of typically even weight or overweight large equity fund managers that are significantly underweight right now, and that could play exactly into what Gavin is talking about.
Yeah, so again, I'm waiting to see the statement and then the reaction. I might play something myself based around that, but I'm kind of with Brett. Like right now, it's a coin toss on what we could do, but I do think that overall, in 2 weeks' time, at this point, all things being even, no big changes to the economic data or earnings that I see as higher at the moment. But certainly really curious to see what the Fed's got to say here.
Sure.
But so I guess we could toss out a couple of asset classes then and see what we think about it. Again, we could just go off the base case scenario with slight tweak in economic language and an easing of inflation. We're just going to go off that as the base at the moment. What do you think that would do with the dollar?
So, I mean, we've already got built-in expectations that the United States is significantly stronger than the rest of the world, and there's a significant short position built up in a number of different things, particularly squared in on the euro. And I suppose that what you just suggested would probably, on balance, is probably what the euro has been doing for the last 3 days. Retaking that breakdown is kind of trying to reposition a bit, because there's a crowd there short, and if we start to maybe kind of highlight the importance of lower inflation readings and maybe kind of move to at least keep that September cut in play, then I think that it's a little tougher to justify as much leverage short the euro. So I suppose that could maybe not do a whole lot, but maybe pull the dollar in a little bit.
How do you view this for your gold trade? Because, I love this gold trade. Jim, I think you're on with that too, right? The gold long?
Let's see. I don't have a current position on in the gold trade currently, but I've been following it with him quite a bit. So, you want me to get a gold chart up? Would that be helpful?
Yeah, if you could, because I'm just trying to, because I like it, but I'm just trying to put together a deflationary environment in a gold long.
Well, let me shift that conversation a little bit. And so I don't know what gold's going to do in reaction to whatever happens today. However, when I see 48 hours from now where gold is, and when I see what happened today, and I put the two together, then I'll know more about whether or not my gold trade will be successful. And I don't know right now. I know that from a technical perspective and from a positioning perspective, it's probabilistically advantageous to be in that position. But I will find out a lot more about it based on the relationship between how gold behaves over the next 48 hours and what we hear today from the Fed. So I don't come into it trying to guess how gold will react. I come into it trying to make sure that I observe correctly how gold is reacting, rather than trying to speculate about it or trying to retroactively reinterpret what the Fed said in terms of what it does. Just take a face value statement, here's what the Fed said, here's what's happening, and then take a face value view of here's how gold handled that, and then I'll understand more about, things don't, most market moves. I think that one huge heuristical error that most market participants make, particularly less experienced market participants, is attributing every single move all the time to things that just happened that day. There's a constant need to do this, and I think that by far and away, the majority of large changes in market prices do not really have to do with, on a big day, when something has a big day, some market moves a lot up or a lot down, and people work so hard to try to explain it. And there's such clickbait out there. Here's why this happened, and there's Bloomberg and CNBC are scrambling to try to frame it in a quick soundbite to explain why this market moved so much that day. But I think most of the time, those moves are not attributable to something that happened that day. They're breaking points or flush points of a process that's built up over time that has much more to do with something that's going on deep under the surface of the market on a larger time frame, a sort of migration of capital that hits certain acceleration points at certain times for its own reasons. And I think that, understanding how gold is able to absorb or make use of whatever the Fed is doing tells me more about that longer term tide, that tidal force underneath the surface of the gold market. And I'm interested to see, so that my conviction level will be in some sense impacted by that.
Okay. Real quick market update. We're slipping to session lows here. Certainly for me, I think this is some people just looking to bank some profits ahead of the Fed. The S&P's breaking down, NASDAQ coming down into some key support levels here while we're talking. So keeping an eye on that action. Go ahead, Jim.
Yeah, Brett, so since we're talking about gold, why don't we talk about copper and this move that we're seeing here? What's going on underneath the hood there?
So I think this is a perfect example of what I just said. I think people are scrambling to try to come up with what
I know I did that on purpose, Brett.
Yeah, that was beautiful. I mean, look at the Australian dollar. It's kind of moved with it a little bit, but not as extreme. We saw an important support level break. A lot of Asia is not trading. Copper certainly tied in there, but I think that it's telling. It's informational that you're seeing this level of weakness in copper, and I think that an attempt to try to attribute it to some specific statement by somebody or some change in something over the last 24 hours is causing this, I think, would kind of misrepresent it. It's important information about that market to see that we're getting moved like this on a day probably without a smoking gun catalyst, and it certainly changes my view. Now, how we react to this, I mean, it's a constantly evolving situation. If this breakdown is immediately retaken the next day, then I think that it is even more important information, because you've really kind of dusted out the bottom of that range, and we already had relatively restricted levels of speculative long interest in terms of the CFTC data in copper, and we've already kind of had the process of acclimating to the idea that we're going to get some form of trade deal at this point. Copper has been largely impacted by the idea of what China's going to be doing. I suppose people positioning around that and betting on that, I think at this point it's sort of written into the market DNA, completely baked in, that we're going to get that trade deal. And perhaps the fact that we had a failed breakout as that realization was coming into play has led some remaining speculative interest to kick out the bottom of the range. But I'm going to be watching it pretty closely.
I mean, there was a lot of damage done today, but all things considered, we've been trading in this range for quite a while. We're not even below the 200-day. I mean, we broke down below, let's see, a March low today. So I think right now it looks a lot worse, only because it's the only market moving. The one thing that has me scratching my head, though, is the fact that we've got most of the world off today, and we're having this big move. And maybe that's part of this reason, too.
Well, I think that's part of it, yeah.
It pretty light volume, right?
Right. Well, it's got to be, because the LME is not around, China's not around, so maybe that just is accentuating the move that we're seeing here today. So, but do you think, let's speak in hypotheticals for a second, we get a continuation of this down move here in copper, and gold moves higher in favor of your trade? What then would you begin to hypothesize about what might be going on?
So the gold-copper ratio is a really important measure, and it gives you a sense of underlying market indications of economic strength around the world. Mm-hmm. I think that generally speaking, when you see the gold-copper ratio move in that direction, it's usually a harbinger of some difficult times ahead, and the opposite is certainly true. When you see copper starting to roaringly outperform and gold sinking, you can construct that ratio. You can look at a chart of that ratio over time, and you can see that it corresponds well with a kind of leading economic indicator in a way. That would be, to see copper continue to deteriorate and see gold work well, that would suggest that the Fed Fund futures are saying something that's more reactive than proactive about, how the future course of things. I have no idea whether or not that's going to be true, but it would certainly put a clue in that box.
Right, and I just wanted to get that out in front of everyone because I could see a scenario like that happening. I think it's more of on the edge of more unlikely. However, when I do see a move like this, it catches my attention, and if nothing plays out from it, then so be it. Then it's just a random move, and we'll adjust accordingly. However, we would be remiss to not at least highlight a potential scenario like this. And when you do see, I don't know. Coming up on the test of the 200-day here in copper, we're just a stone's throw away from it. I would definitely start to get interested. You haven't traded copper in a long time.
You're correct. I have not.
Yeah. Well, maybe that changes, huh?
And maybe sometimes it becomes a very primary market for me, and it actually has been quite a while.
Yeah, it has. All right. I guess we should talk about the treasuries. You're not involved in treasury anymore, are you? In the
Correct,
bond futures?
I'm not.
Okay. Are you sizing that one up at all?
Not at the moment, no. I don't feel like I've got an edge there.
All right. Moving right along. Let's talk about crude.
Yeah, today was face value really bearish data in the EIA, and I think that crude, it's going to be another interesting reaction. Obviously, if you get a justification for a proactive loosening of policy over the coming term, that would seem to be something that should be face value very bullish for crude, and if it can't really rally on it, then that would put me in search of a larger pullback, perhaps to that 60 area. You got a confluence of the 50-day and 200-day possibly coming together around 61 or just under on the continuous contract chart, which would be a target for a short. So if I felt like we got something that bumped equities up, we got something that looked like a proactive Fed, and we got crude oil, couldn't really rally on it, then I think you've refilled some short-term weekend speculative money back into crude oil off the Fed that then is going to be easy to knock back out following a data set like we had today.
How concerned are you about what's going on in Venezuela?
Not at all, because honestly, Venezuela had been checked out of the system pretty much across the board ahead of this. I think that if anything, if you see escalations of tension there, they almost move crude in the opposite direction, weakening it, because right now the status quo is Venezuelan production is tapered off to practically nothing, and when you look at the world oil market, and if somebody's able to seize full control there and get the system started back up, particularly if the revolutionary forces manage to take control of the military at some point somehow, or they've got so much international support, it's possible that could happen. If that happens, I think that there would be much more of an international inclination, removing all sanctions, getting Venezuelan oil back on the market. So I would think that this tension is actually something that's probably it hasn't been played this way in the media, but I would think that it's actually a bearish factor right now in the way crude oil is trading, because it means more supply could come back on from Venezuela sooner.
Ah, very interesting. All right. Were there any other talking points that we need to hit on, Gavin?
No, I think, we've pretty much covered what we're looking for in the release. I think there's such uncertainty in terms of market reaction and overall expectations for how they will go about trying to achieve their end game, that you're best off not trying to make a big bet in either direction. I'm still of the mindset that at some point we're going to see people attempt to lean on this, and I think that you're going to buying dips is going to end up being the way. So that's what I'm kind of looking for going into this report. But again, as Brett said, until we see what's actually out there, it's a little tough to try to predict, given how slight the tweaks are going to be. It's tough to predict exactly how the market's initial reaction is going to be to it.
So one other point I want to get to, because somebody asked a question over email about this earlier. So the Fed, as of its last meeting, I believe they went to zero hike projection, correct?
For
the Fed, from their own, the dots, the average dot, the consensus.
Yes, correct.
Yes, zero hike, and the Fed funds futures are pricing in one hike, or one cut. So for the Fed, the expectation is flat. For the Fed funds futures, the expectation is one rate cut. And that is the current relationship between the two. So with what we have seen over for quite some time now, is a process of the Fed chasing the Fed funds futures. The Fed funds futures being an accurate and reliable predictive estimate of future changes for the Fed. I think that it's been a long time since we've seen that basic idea not be true. So that would suggest that the Fed is in a gradual process of acclimating toward a cut. And right now, it's particularly interesting, as we've highlighted, because you don't have a clear face value economic data justification for that. And so I think that really resolving that tension is what this and the next Fed meeting are really all about for the markets.
All right. Well, if that wraps things up, Gavin, I think we should let everyone get prepared. Maybe we'll be able to get this out in front of everyone if they missed anything. And the good news is that you guys will both be around to help us sort through what to make of the actual release itself. So I'm going to be looking forward to that.
For anybody wondering what the schedule's going to be, I think the plan, Brett, is for us to jump on shortly after the release, kind of give our first take. And then we're going to have Powell speaking. I'll be listening to him, and then we'll probably circle back around at 3:30 before the markets close just to do kind of a quick retake and maybe a little bit more of an in-depth dive tomorrow morning. Does that work for you, Brett?
It sounds good.
All right, great. So if anybody's got any questions on anything, certainly feel free. Again, also keep an eye out on, or double check my preview for some of the things that could be changed in the statement that we're going to be watching closely.
And for anybody who needs that, just type in EVENT, scroll down just a little bit. It is yesterday at 13:07 is that timestamp, and that'll give you a really good, nice recap of some of the things that we talked about today. All right, gentlemen, thank you so much.
All right, thanks a lot, Jim. We'll talk to you soon.